We'll read together. Is it okay? So we'll now try to do some questions to understand the behavioral biases of individuals better. Frank Brooks and Peter Timmons are portfolio managers for the largest mutual fund of Liberty Financial Advisors, which provides a variety of mutual funds for both individuals and institutions. Brooks has been a portfolio manager for 8 years and has seen both bull and bear markets. Timmons is his assistant and has been at Liberty Financial Advisors for the 2 years following his graduation from a prestigious Master of Science in a finance program. In their discussion over lunch, Brooks and Timmons discussed the latest quarterly earnings announcements for several firms in their portfolio. Despite optimistic projections for some firms, most announcements were quite disappointing. Timmons states that he is not convinced that their prospects are as grim as the announcements suggest. So, in reading case studies like this, always focus on the points or the statements where somebody makes a statement, or where some individual or investor or fund manager makes a statement, because the question would be a bias related to the statement that has been made. The next day, Brooks and Timmons provide a presentation to Liberty Financial Advisors clients. Their guest presenter is Stephen Davis, an economist at the local university who frequently provides economic commentary for national media outlets. During his presentation, Davis states that it is likely that the United States will enter a recession next year. He recommends that the clients shift their assets into investment grade bonds and non-cyclical stocks. He states that he has been successful in predicting recessions over the past 15 years and is certain of his forecasts. We can clearly see an overconfidence bias here. He states further that the only time he has been wrong in predicting the business cycle is when Congress unexpectedly increased spending beyond that was expected. We see some indication of the hindsight bias here. He states that if that had not happened, his prediction of a mild recession would have been correct instead of the mild expansion that actually occurred. Again, these are possibilities. Possibility of hindsight bias and an overconfidence bias. Possibility of conservatism in Timmons' statements that we saw earlier, that he is convinced that the prospects are not as grim as the announcements suggest. During the afternoon session, Brooks discusses the various strategies at Liberty Financial Advisors. In the value/neglected firm strategy, Liberty Financial Advisors seeks out firms trading at reasonable valuations with no analyst following. Brooks states that several academic studies showed that these firms to be good investments over a 3-year time horizon, from July t equal to 0 to June 30 t equal to 3, following their identification on June 30th of year t equal to 0. Brooks states that he has adopted this strategy for his portfolio. Now, again, this is an example possibly of the sample size neglect, because he's seeing the last 3 years and he's extrapolating that for the next 3 years as well. So sample size neglect is an example of representativeness, a part of the belief perseverance cognitive error that we studied earlier. Later that evening at dinner, Brooks, Timmons, Davis discussed the day's events. Commenting on investment strategies, Davis states that he focuses on growth stocks with 6-quarter earnings growth and monitors his portfolio on a quarterly basis. Davis also states that when short-term moving average rises above the long-term moving average, this signals an opportune time to trade. So basically he's just following some technical analysis. Which of the following describes Timmons' behavioral characteristics? Timmons uses frame dependence, uses anchoring, or is loss averse. So we will go back to the first statement that Timmons had made when he stated that he is not convinced that the prospects are as grim as the announcement suggests, despite most announcements being disappointing. So again, conservatism, anchoring are both possibilities here. So if it was either conservatism or anchoring, that was a choice that we would have gone on. So it is possible that Timmons uses anchoring, or he is anchored to his original beliefs or original forecasts. Which of the following best describes Davis's behavioral characteristic? So we'll again go back to the statements that Davis had made, and he was pretty confident about his forecast that there will be a recession next year, and he was advising clients, and he explicitly states that he has been successful in the past and he's certain of his forecasts. So he potentially may be suffering from the overconfidence bias. Which of the following likely explains Davis's behavioral characteristic? Davis uses a bottoms-up approach to assess his skills. No such indication or no such detail mentioned in the case. Is susceptible to cognitive dissonance. Please remember, cognitive dissonance is the difference between a person's actions and beliefs. I believe I am a good fund manager. However, my performance has never been good. It's cognitive dissonance. That actions are suggesting otherwise, my beliefs are otherwise. People strive to minimize cognitive dissonance. Davis feels he has correctly predicted recessions, whereas actually he was not able to predict the recession in one particular year. There is a cognitive dissonance between what actually happened or what was the action and what his belief is. Davis would want to minimize that belief, and hence he's giving explanations that it was an external factor, it was what Congress did that caused a prediction to go wrong. So he is susceptible to cognitive dissonance and wants to minimize the cognitive dissonance because there is a variance between his actions and beliefs. Which of the following best explains Davis's defense of his past inaccurate forecast? Davis is exhibiting the behavioral bias of self-attribution, representativeness, or illusion of knowledge. So amongst the options, the best pick would be self-attribution. That is, he is taking the credit for all his right forecasts. So when all the predictions were right, it was his claim. At that time, it wasn't some unexpected occurrence because of which actually a recession happened. All the correct forecasts were his own doing and his own analysis. The only incorrect forecast that he had made was also not because of his mistake, was because of somebody else, or was blamed on external factors. Please note, representativeness, illusion of knowledge could have also caused the same behavior. However, you have to focus on the reason or the statement that the client has made for doing a particular action that will tell you which bias exactly is he exhibiting. So in this case, it is the self-attribution bias that is most evident, as he is claiming all the good results for himself and is blaming the environment for whatever went wrong. Which of the following would most likely be classified as an emotional bias? Investor has difficulty interpreting complex new information. That's exactly what cognitive biases or processing errors are, because they cannot process complex information. Only partially adjusts forecasts when he receives new information. So he's not fully adjusting his forecast. This is most likely the anchoring and adjustment bias. Conservatism is more like he's ignoring, or he feels that the new information doesn't impact the stock or doesn't impact his analysis. When you don't fully recalibrate, there is normally anchoring and adjustment. Again, a processing error or a cognitive bias or a cognitive error relating to processing. Has a tendency to value the same assets higher if he owns them than if he does not own them. This is the endowment bias. That is a emotional bias. Which of the following would most likely indicate that an investor is subject to an emotional bias? Regularly basing decisions on only a subset of available information. Could be representativeness, could be availability. Reacting spontaneously to a negative earnings announcement by quickly selling a stock, this is most likely regret aversion. If earnings announcement is negative, everybody is selling, he doesn't want to be the last person selling. Or when you know the earnings are bad, you want to sell it off, otherwise there will be a feeling of regret that I knew the earnings are bad, still I did not react. Remaining invested in a profitable technology stock, even though new information indicates that its PE ratio is too high. Again, could be conservatism or anchoring and adjustment. So, which of the following most likely indicates that he is subject to an emotional bias? It would be option B, which is clearly the regret aversion bias. Rest could be emotional or cognitive. C definitely looks like a cognitive bias, either anchoring and adjustment or conservatism. Could be status quo also, but definitely statement B clearly indicates that it is regret aversion, which is a emotional bias. A cognitive error is best indicated by which of the following? Taking more and more risk because the investor mentally attributes his recent investing success to his strategies. So this is the self-attribution, which is a part of the overconfidence bias. Ending up with a suboptimal asset allocation because the investor does not use a holistic approach to construct his portfolio. This is mental accounting, which is a cognitive error relating to processing, or it is a processing error. Experiencing a significant loss on an investment because the investor hoped to recover from a negative position that subsequently worsened is the loss aversion bias. So both overconfidence and loss aversion are emotional biases, whereas mental accounting is a cognitive error, so B will be the correct option. Don Henry has just received new information regarding his investment in Orange Incorporated. The new information appears to conflict with his earlier forecast of what the stock price should be at this point. Nonetheless, he is unwilling to incorporate the new information into his forecast and to revise it accordingly. What behavioral trait is Henry displaying? So in this case, Henry is unwilling to incorporate the new information at all into his forecast, hence indicating a bias of conservatism, that is belief perseverance error, wherein he wants to stick to his old forecast. Anchoring and adjustment would be a close second, which is what we would have ticked had he acknowledged the information but was not correctly or completely incorporating it into the forecast. So if he didn't revise the target price sufficiently, or if he didn't change his forecast sufficiently, then anchoring and adjustment would have been a better alternative. If he's assuming that the information is not relevant at all or not incorporating at all, then it is a bias of conservatism, which is a belief perseverance bias, rather than anchoring and adjustment, which is a processing error. Abby Lane is a savvy investor who has investments scattered across many different accounts, from bank savings and before and after tax retirement accounts to taxable non-retirement accounts. She also has several different investing goals, ranging from important short-term goals to long-term wish list goals. Even though she has many investments across different goals, she is smart enough to take into consideration the correlation between her assets. She allocates the assets according to her risk-return profile across different asset classes, viewing the investments as comprising a single portfolio with a single measure of risk. What behavioral trait would represent the opposite way Lane approaches investing? So this is exactly how it should be done. Mental accounting is how it should not be done. So the opposite way would be mental accounting. 20 years ago, Jane Ivey set her initial asset allocation in her defined contribution plan by placing an equal amount of asset in each class and never changed it. We'll study later, this is also referred to as 1 by n diversification. That is, all classes that are presented, you invest an equal amount in. Over time, she increased her contribution by 1% per year until she reached the maximum amount allowed by law. Due to her steadfastness and good fortune, coupled with matching funds from her employer, she now finds herself in her early 40s with $1 million retirement account. Which of the following biases does Ivy suffer from, and how should she remedy that bias? So it's not representativeness because there is no heuristic that is being talked about. It most likely is the status quo bias because she made an initial allocation of a particular percentage in each asset class, and then even though she is aging and her circumstances are changing, she's not changing her asset allocation in percentage terms. She's only contributing 1% additionally to all accounts. So most likely it is the status quo bias. We should educate the investor on trade-offs between risk and return and subsequent proper asset allocation. It is not the availability bias because she is not trading on any recent news or any available news. Ms. Z is a new client of BF Advisors. BF begins each client relationship with an extensive set of interviews. These interviews determine Ms. Z has very low needs in relation to her wealth. With even modest diversification, there is no reasonable likelihood that she could outlive her assets. That is, spend out or use all the assets in her lifetime. In addition, she is expected to inherit large sums from her mother's estate. The estate settlement is expected in the next year. BF also uses a set of standardized questions to identify the biases of each client. Ms. Z shows strong tendencies to conservatism, sample size neglect, framing, endowment, and availability biases. After completing the questions, she meets with her BF portfolio manager and asks for further information regarding the biases. She has always enjoyed studying new areas and learning new approaches to life. Recommend whether her biases should be accommodated or modified, and whether her portfolio will deviate from a traditional optimal allocation. So we see that she suffers from both cognitive as well as emotional biases. Endowment is in fact the only emotional bias we see. All the others, conservatism is a cognitive error, sample size neglect would be a processing error, framing is again a processing error, a cognitive bias, and availability would also be a processing error or a cognitive bias. So even though she is relatively well off, we should make some effort to mitigate these biases. However, to a fair extent, we can also accommodate the biases if need be because she is significantly well. So that was about the review on behavioral biases of individuals, an important topic, a very testable topic. Make sure you practice many more questions, can be asked in both the essay type paper as well as the item set type paper. Arguably the most important topic after individual investor and portfolio manager for institutional investors. So thanks a lot and see you next time.